In this video, I'm going to explain why not to buy any company in the telecom industry, but in particular Verizon Communications. I'm going to run through even the valuation model for this company, telling you what I believe to be their intrinsic value, their acceptable buy price given our investor margin of safety. I'm also going to run through the financial metrics, the dividend safety of this company, tell you what the institutions are doing, positioning themselves for Q4 and beyond. I'm also going to take a look at how the industry has performed as a whole over the last year and the last 5 years. And as always, we will run through their balance sheet, pointing out what I do believe to be some strong red flag indicators, as well as their top line and bottom line revenue net income. So firstly, one thing to point out, this industry, and in particular Verizon, is down 24% over the last 10 years. So whatever your position in this company would have been 10 years ago, at this point in time, if you didn't reinvest those dividends, your capital would be down by 24%. Now, year to date, this company is also down 7%, as we can see, with the S&P 500 up around 25% year to date. Now, Verizon itself is in the midpoint of the 52-week range, and as we can see, does offer a very high yield of 7.11%. Now, taking a look at their income statement, now regular viewers, you know we tend to look for 3 to 7% growth year on year. Now, December 2018, 131 billion reported on their top line. December 22, 137 billion. So we are talking about roughly a 5% increase, not year on year, but over the last 5 years. Now, you know what we're saying, we always want to keep up at a minimum with inflation. Now, when we look in granularly, we see 2018 to 2019, it increased very minimally, decreased in 2020, increased slightly in 2021, and again in 2022, and 2023 expected is going to be lower from the trailing 12 months. So two things, not only do we see inconsistencies up and down year on year, but we also see they aren't even keeping up with inflation, with some years negative growth. Now, we will touch upon this when we look at those metrics to analyze the last 10 years percentage-wise too. Now, when we look at the bottom line, 15.5 billion in net income in 2018, 21 billion in 2022. So what they have managed to do, even with their top line, which has been inconsistent and not even keeping up with inflation, they have managed to increase that bottom line by nearly 50%, which is pretty admirable. And as we can see, again, there has been inconsistencies with an increase to 2019 before dropping in 2020 and then picking up and then dropping again. Although do note, trailing 12 months is showing us a decrease. So the question remains, how long can Verizon continue to have top line below inflation or negative and increase their bottom line? So that is a lot of things to think about. They aren't increasing in line with inflation, but their bottom line, they are managing to increase. How long will they be able to keep this going? Now, their cash versus their total debt, just a quick check of their healthcare. 2.7 billion worth of cash and short-term investments in 2018, 4.3 billion from their latest report. So they have managed to increase their cash over the last 5 years. Now, when we do compare that essentially to their total debt numerically and directionally, 114 billion worth of debt in 2018. But hold on, they have managed to increase that to 178 billion in their latest report, which is a huge amount, especially when you compare it not only to their total cash, but to what it was 5 years ago. This is a company that not only has a large debt position, but seems to continually to increase. Now, let's take a look year to date. Some of their competitors in the industry, the integrated telecom services. We have Deutsche Telekom, AT&T, and a few well-known others. Now, year to date, Verizon, if you have been reinvesting those dividends, you'd be pretty much flat on your return. But something to note here, the industry as a whole, other than Deutsche Telekom, hasn't performed the greatest. Other than Deutsche Telekom, which is up, in fact, 22%, the next highest is NTTYY with 6%. So, okay, year to date, we shouldn't be looking so small term. Now, over the last 5 years, Verizon, if you've been increasing those dividends, or in fact putting those dividends back into the company, reinvesting on drip, they're down 9%, the worst performing. You have AT&T over the last 5 years up 11%. Now, the other ones in the industry we do see up significantly better, up 66%, NTTYY up 56%, TLGPY up 74%. But what we are seeing here is, if you are picking the wrong companies in the telecoms, then you will be severely hammered for it, as we can see with Verizon, with AT&T. Now, it doesn't necessarily mean you shouldn't invest in the telecoms industry, but who's to know over the next 5 to 10 years whether these companies will return a similar fate that AT&T and Verizon have had over the last 5 years? Is it something you're willing to bet versus other companies that you'd be much better off investing in? Now, in terms of the institution, we do see 61% institutional ownership. Now, 11 billion worth of these inflows over the last 12 months, 22 billion over the same period. So yes, institutions are buying more than they are selling, but as I always mention on every single episode, it is very important to understand you shouldn't be doing any investment decision based on what the institutions are doing. And one thing to note, whilst there has been more buying than selling over the last 12 months, in Q3 of 2023, we do see, in fact, more selling by these institutions than buying. So lots to consider as we run through the information. Dividend safety score 70, it is safe. Market cap 157 billion, it is a mega cap company. Now, in terms of recessionary metrics, well, they did manage to increase the dividend during the 07-09 crash. Negative 1% sales, bear in mind that was above the average growth of companies in the S&P. And they did also manage to beat the S&P with a negative 38% return versus the S&P 500's negative 55%. Now, dividend growth, yes, a lot of people will be cheering 7.1% yield, incredible, we love this, etc. But you're not even keeping up your essential dividends with inflation. 1.9% increase this year, 2% over the last 5 years, 3% over the last 20 years. Remember what I always say, I always advocate a minimum of 4% increase, whether that's to your dividends, whether that's to your other income producing assets or your salary. If you're not getting a minimum of 4%, which was the average inflation over the last 40 years, you are taking a pay cut and losing your purchasing power. So this is biting into your 7% yield. Now, when we take a look, dividend growth, they have been increasing the dividends for the last 16 years. Now, yes, dividend yield theory, it does state it is undervalued as the current yield sits above the 5-year average, as we can see here. Same goes for the forward PE, 8.3 versus 10.8 on the 5-year average. And when we compare it to the communications sector as a whole, 18.3, Verizon is significantly lower. Now, when we look at the free cash flow payout, now this is very important. Earnings is susceptible to manipulation by management through accounting, and this is why I always say personally below 60% or more, because then it gives me faith that management can offer those double-digit increases. But if you look at 2022, oh, you're happy. Below 60% is 50%. Yes, let's have a party. But then look, 2022 free cash flow, what it's saying here is in 2022 you would be paying out, or in fact, the management were paying out more in dividends than they generated in free cash flow. That is quite a red flag indicator by any margin. 2023 expected, in my opinion, still to be very high at 81%. So just bear these in mind. Free cash flow per share, it has been decreasing. You don't really want to be investing in any company where the free cash flow per share is going downtrend. You want to be going up. 829 in 2013, 248 in 2022. Yes, it is going up, expected in 2023 to 325, but just take a look at the past. That's not even as high as it has been on many occasions over the last 10 years. Sales growth, again, is it keeping up with in line with inflation? We want 3 to 7%, 3 to 4% as a real minimum. Negative growth in 2016, negative growth in 2020, negative growth expected in 2023, 2% growth in 2022, 1% in 2019, flat in 2017. Now, when you look at that numerically over the last 10 years, it's gone from 121 billion to 137. So it isn't keeping up with inflation. That is a fact. In terms of real revenue, they are in fact decreasing. On top of that, shares outstanding. You've heard it many times. We love it as investors when companies do share buybacks, returning excess cash to our pockets. Well, they've done the opposite. In fact, they've issued shares, diluted your position as a shareholder. 2.87 billion in 2013, 4.2 in 2022. So we can see here they've increased the share count quite considerably. Now, when we take a look at the ROIC, one positive factor, yes, we like to see double digits. It gives us faith that management are able to effectively allocate their capital. But look, from 2015, this has been decreasing nearly a percentage every single, or a percentage point, I should say, every single year. Do keep an eye on that, because as that starts to come down lower and lower, for me personally, this would be a lot more less attractive. So these are things that I am just saying just to keep in mind. Now, look, their margins are fairly decent. It is above that minimum 14% we look for as our preference in the telecoms industry. So that is one positive. Free cash flow margin, a bit more inconsistent. We like to see 7% or more. They did manage that in 2022 and 2023 it is expected. Now, net debt to EBITDA, remember this signals two things. It's the earnings before interest, tax, depreciation, amortization. Signals the balance sheet strength, the dividend safety. Well, these show us the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 3.37, so it isn't above the maximum we like to see, and 2023 it is expected to be roughly in line, so we do see why that dividend is safe. But personally, when looking at that balance sheet, we do see a significant amount of debt, which, yes, granted, you expect from the telecoms industry, but it only seems to be going higher and higher. So that is the essentially the metrics analysis of Verizon. Now getting into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And finally, if you do want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. So Graham's valuation, the first model, we have the stock ticker symbol VZ, earnings per share growth rate with that yield on AAA corporate bonds. Intrinsic value coming to $38. Now that is pretty much in line with the current trading price, so based on Graham's model, we see around reasonable valuation to the current value in the market. But do bear in mind we don't look at any of these models in isolation and we draw our conclusions towards the end. Now in terms of the multiples valuation model, the only real company that I could really compare it to is AT&T, but given the fact it has negative earnings per share, this model will become irrelevant. So moving on to the second model, we have the dividend discount model with the average growth rate of 1.84% over the last few years. Forward looking, I've gone for 1.25%. It is lower than the average growth rate, but higher than the most recent payment. So I do believe it to be a fair/conservative estimate. But as always, if you grab a copy of the model, you can play around with these numbers based on your own investment thesis. So $39.60, we can see around 5% upside to the current trading price, but still below that 52-week high. Now, when we move on to the third and final model, the DCF model, we have the free cash flows year on year. Average growth at 14.5%, forward-looking, analysts estimating 6%. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash to subtract total debt, get to the equity value, divide by the shares outstanding. We get a DCF price of just under $40. Again, here we see around 5 to 10% upside, but still below that 52-week high, showing some signs of undervaluation. Now for today's episode for Verizon, the intrinsic value is the average of those three models we ran through, coming to $39. As always, don't forget, if you're enjoying the content, values being provided, it really helps the channel. Smash that like button and hit the subscribe and bell button if you want to be continually notified of these videos as they drop. Margin of safety now, 10% is the minimum we use, and that is if we believe the company has a wide moat, strong financial metrics, good forward-looking data. Now, personally, for Verizon, I would believe you need a much larger margin of safety than 10%, but if you were looking at that, your acceptable buy would be around $35. Now, personally, for the telecoms industry, it isn't one I would add in my portfolio, but I would be looking at a much higher rate. At those at 20%, around $31. Those looking at 25%, around $29.37, as we can see, just near that 52-week low. So in conclusion, we can see that it isn't even have a 5% margin of safety, although it isn't too far off. What do Wall Street say? Well, for Verizon, they see it going up to $40, so they see around 5 to 10% upside. In conclusion then, for Verizon, it isn't one I would add. We ran through all the negatives. There were one or two positives, but what we're saying based on our model is that it has currently a margin of safety of 5%, with around 5 to 10% upside over the next 12 months based on Wall Street targets. As always though, if you've enjoyed the content, different type of content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos. And as always, do click on that pinned comment below if you do want to grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio or on your watch list.